Good afternoon and welcome to lecture 9 on ETC 779. In previous lecture we had discussed about present worth computations, and in that lecture I could cover the situation in which both the alternatives we were considering had equal lives. If you remember, I had given you three situations under present worth comparison. Case 1 was equal lives, case 2 was unequal lives, and case 3 was related to infinite lives. So, in lecture 8 we could cover equal life situation, and there you had found that in order to compare the alternatives you have to first draw the cash flow diagram. So, step 1 is drawing the cash flow diagram. Step 2 was calculating the present cost or present worth or net present worth. Any one of these, depending on whether your cash flow diagram is cost dominated, revenue dominated, or it is of a mixed kind. So, that was as far as step 2 was concerned. Step 1 was drawing the cash flow diagram. Step 2, calculating the present cost or present worth or net present worth, depending on whether the cash flow diagram is cost dominated, revenue dominated, or is it a mixed type. Then finally, as in step 3, we were taking a decision based on least cost, that means whichever alternative was having the lowest cost was the most economical one. Similarly, whichever option, whichever alternative was giving me the maximum present worth, we were selecting that, and finally, we were taking that alternative which has got the maximum net present worth. This net present worth is also sometimes referred to as net present value. So, if you remember, net present value was calculated corresponding to the situation in which we have the information on cost as well as revenue part both. How to calculate net present value or net present worth? It is very simple. We take the difference of present worth of revenues and present worth of cost. So, basically net present value is the difference of present worth of revenues, that means whatever you are earning and what is its present worth, and that I subtract it from my expenditures present worth. So, this is as far as definition of net present value or net present worth is concerned, and this we were finding when we were given a mixed kind of a cash flow diagram. That means, I have the information on expenditure as well as on the receipt part, both the informations I have, incoming as well as outgoing. Both these data are available to me, and then only I am using net present worth. The alternative with the maximum net present worth is to be selected. This is as far as decision rule is concerned. So, that was the review of lecture 8 of this particular course. Now, in this particular lecture, we will see the remaining part or the remaining cases pertaining to present worth computations. So, the second alternative, I mean the second case pertaining to present worth calculations was situation involving unequal lives. So, if you see this title, it says alternatives with unequal lives. In many situations, it so happens that for one alternative you will have a different life, maybe 5 years. For second alternative its service life could be 10 years. You may come across numerous situations. For example, there could be a equipment for which the service life specified is 5 years. In another situation, for the same purpose, another manufacturer comes with an equipment with a service life of 7 years or maybe 10 years. Now, you simply can't compare them. Why? Because one equipment has got a life of 5 years, another equipment has got a life of 10 years. So, naturally, the expenditures that you will be incurring and the return that you will be getting out of operation of these two equipments will not be matching. So, how to do present worth comparison for such situations? That is what is covered under this particular class of problems. So, the essence of this particular type of problem involves different lives. Now, there are two approaches through which these class of problems are solved. The first approach under this is called the common multiple method. It is called the common multiple method. Sometimes this is also referred to as repeated projects method. It is referred to as repeated projects method. So, whenever you find these two terms, you understand that they are all same. So, either you call them as common multiple method or you call them as repeated projects method. So, that is one way of solving this class of problem. The second approach is known as the study period method. There are numerous methods through which such problems can be tackled. However, we will see these two type of solution methodology only. The first one is the common multiple method, which is also known as repeated projects method, and the second one is known as the study period method. So, now I will go to each one of them and explain it to you through a simple example. Now, as the name suggests, common multiple method, what we do in this particular type of problem is to take the least common multiple of the different life periods. Suppose one equipment is having a life of 5 years, another equipment is having a life of 10 years. So, what is the common multiple there? 10. So, we will do our analysis for a period of 10 years. Take another example. If the life of one alternative is, let us say, 2 years, and for another alternative, let us say it is 3 years. So, how much would be the analysis period? Simple. Take the least common multiple of their life periods, which in this case would work out to 6 years. Now, what do we do with this 6? That means, the method suggests that the alternative with a life of 2 years, you repeat that investment 3 times. What we do? The alternative with life 2 years, I repeat it thrice, 3 times. Similarly, the alternative with 3 years life, I repeat it how many times? Twice. So, this is what is called the method of common multiple. So, this is one approach. So, if you see this is what has been written down in our slide. it says that the alternative with 2-year life shall be replaced 3 times, so that the analysis period becomes 6 years. Similarly, the alternative with a life of 3 years will be repeated twice, so that we achieve a coterminous life period. Note this term coterminous means both the alternatives converge at some point, and that point in this problem becomes 6. Now, the assumption that we are making while solving the problem through this approach is given down as a last point, which states the assumption stands valid if the common multiple of alternative life periods is small. So, this analysis methodology we perform only when the period considered is very small. Otherwise, you will find that the philosophy won't work. And what is the philosophy? We assume that during such a short period, there is practically no possibility of new development under that kind of product or under that kind of investment. So, that is why we are considering a very small period. Now, if you apply this method for an alternative having a life of 20 years and another alternative with a life of 30 years. Now, this analysis method may give erroneous result. Why? Because it is expected that in such a long time, 20 years and 30 years, technology may change drastically, and hence the very basic assumption itself will go wrong. So, that is why this methodology you use it for a very short period, maybe 2 years, 3 years, because during such period we anticipate, we expect that there won't be much change as far as technology of that particular equipment is concerned, technology or investment alternative is concerned, no drastic change. So, this is the caution that you have to take. That means, you should not be using such you should not be using this method for situation involving large service lives, right. So, this is as far as the concept of common multiple method is concerned. Now, I will give you a quick example. You please note down this problem. It says assets A1 and A2 have the capability of satisfactorily performing a required function. So, there is some work to be done, and you have 2 assets, or it could be 2 equipments which can perform these functions. I have already sent you these slides. So, even if you miss certain lines, it does not matter, you can cross check it with the email which I have already sent. Now, asset A2 has an initial cost of rupees 160,000 and expected salvage value of rupees 20,000 at the end of its 4-year service life. So, the information on asset A2 is given to you. It has an initial cost of how much? Rupees 160,000. And what is its expected salvage value? Salvage value is basically the money that you realize by selling that particular equipment at the end of its service life. So, suppose after 4 years, since 4 years is the service life, you find that equipment is unusable, so you sell it. So, the money that you realize at that point of time is known as salvage value. So, the initial cost is given to you, its service life is given to you, and salvage value is also known as far as asset A2 is concerned. Now, information on asset A1. Asset A1 cost rupees 45,000 less initially. So, how much does it cost? 160,000 less 45,000, that is 115,000 it costs. With an economic life 1 year shorter, so its life becomes 3 years than that of A2, but A1 has no salvage value and its annual operating costs exceed those of A2 by rupees 12,500. So, although the initial cost is less, but its operating cost is more when you compare it with A2. Now, the required rate of return is given to be 15%. Now, you are supposed to tell me which alternative is preferred when the comparison is by first the common multiple method and second, that we will discuss little later, a 3-year study period method. So, for the time being, answer the first part, that means use the common multiple method and tell me which alternative you are going to adopt. Problem is clear. You have got two assets which can perform the same function. For both the assets, the initial investment is given to you, right? For both the assets, you know their service lives. And what did you notice in service life? For asset A2, its life is 4 years. For asset A1, its life is 3 years. So, now you can understand the difference. In yesterday's lecture, we had taken all the problems in which the life for both the alternatives were same. It was all equal, whereas in this particular problem you find that both the assets have got different lives. For asset 2 it is 4 years, for asset 1 it is 3 years. So, if you are using common multiple method, what I have to do? I have to repeat 4 times the alternative with life 3 years, so that it reaches 12 years, which would be the analysis period, because for 3 and 4 the common multiple would be 12. So, the alternative with 3 years life I have to repeat 4 times, and the alternative with 4 years life I have to repeat 3 times. Clear? So, as a step 1, what you have to do? You have to draw the cash flow diagram. That step remains common. Step 1, you will have to draw the cash flow diagram. So, this is what is the cash flow diagram for asset 2. It is very simple to make. At time t is equal to 0, you find asset A2 costs 160,000. At time t is equal to 0, the cost is 160,000, right? If you try to see it here, it will be more clear. Just look at this screen. As far as asset A2 is concerned, you are investing 160,000 at time t is equal to 0, that means now. Then you find that its salvage value at the end of year 4 is 20,000. This is end of year 4. So, somewhere here 1, 2, 3 and 4. You can understand the sign convention here. 160,000, it is a cost for you. So, it is going towards negative. Whereas salvage value you will be receiving. So, that is why I have kept it in positive side. And this salvage value of 20,000 you are realizing at the end of year 4. This is as far as asset 2 is concerned. This is the cash flow diagram of asset 2. Now, when I draw the cash flow diagram of asset 3, how it would look like? At time t is equal to 0, how much I am investing? 45,000 less than the previous asset, asset A2. So, how much it would be? It would be 115,000 at time t is equal to 0. It has no salvage value, that means at end of year 3, because if you see for asset 1, I am drawing this for asset 1, it has got a life of 3 years only, 1 year shorter than asset A2, but it also has extra operating cost. By how much? Extra 12,500 for these 3 years. You can understand, I have written all these cash flows in negative side. Why? Because everything is going out of my pocket, I am not receiving anything. That is why all these things are shown on negative side. Now, you must be thinking about one thing, why I have not bothered to draw operating cost for asset 2. It won't make any difference, because our problem says that for asset A1 the operating cost is 12,500 rupees higher than the previous one. So, no matter whatever is the operating expense for alternative asset 2, the same diagram holds good. So, if you look at this diagram, now you can notice one more thing, for asset 2 life is 4 years, for asset 1 life is 3 years. So, this is a problem in which alternatives have unequal lives. Unequal lives. Asset 2 has got 4 years, asset 1 has got 3 years. Now, as I told you, there are 2 ways, in fact there are more ways, but we are discussing only of 2 ways. One way is common multiple method and second one is study period method. So, first I will tell you how to solve this using common multiple method. So, the first diagram for asset 2, you just see how I am making. Let us say this is year 4, year 8, and year 12. This is time t is equal to 0. So, this is 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 and 12. So, what I have done is I have repeated this particular alternative thrice. Life is 4 years, I have repeated it thrice, and now just see what I am doing. As far as initial investment is concerned, this is 160,000. At the end of year 4, I am getting 20,000. Now, just see here, this is at the end of year 4, I am repeating this investment again. That means, I will assume that this equipment has performed its function and I want to buy a new equipment, and assumption is that I am getting that equipment at the same price, 160,000. Now, this equipment again will work for 4 more years. At the end of 4 years, I will again be able to realize 20,000 as salvage money, and then again I have to invest 160,000, so that at the end of year 12, I am again getting 20,000. So, is it clear to you what I have done? I have repeated the investment of 4 years over next 8 years further. That means, I am going up to year 12. This is what you have to understand, and that is why the name is also repeated projects method, or you call them as common multiple method. Now, can you do the same cash flow diagram for asset A1? This is as far as asset A2 is concerned. Now, do it for asset 1 on your own. The same diagram I have drawn it on computer also, and it is something like this as far as asset 2 is concerned. So, you can notice that at time t is equal to 0, 160,000, and then at the end of year 4 also 160,000, at the end of year 8 also 160,000, and you may notice the salvage value also at the end of year 4, at the end of year 8 and at the end of year 12. Now, following the same methodology, try to do for asset 1 also. You will find that for asset 1, you have to repeat the investment how many times? 4 times, because for asset 1 the service life is 3 years. So, this investment I will repeat it 4 times, so that I reach at the common level 12 years. Once I reach 12 years for both the alternative, I can use the method for equal lives and then solve the problem. Now, I will also show you how to draw it for, this is as far as, if you see here, this is as far as asset 2 is concerned, right. Now, I will do it for asset 1 in a separate piece of paper. So, let us draw a line. This represents time t is equal to 0. Then you have 3, 6, 9 and finally 12. So, I have an interval of 3 years period, 3, 6, 9, 12. So, what in fact we are doing is we are repeating this 4 times. At time t is equal to 0, I am investing 115,000, and besides this, year 1, year 2, year 3, all this is 12,500. At this point, that means at the end of year 3, I will have again investment of 115,000. Clear? Now, this 12,500 would continue for year 4, year 5, and here again we will have one more 115,000 in addition to this 12,000. Then for year 7, 8, same manner, 9 again you will have 2, 10, 11 and finally 12, 2 values. No, here there won't be like this, it is something like this. So, what you find is that 115,000 initial investment, you are putting it at end of year 0, end of year 3, end of year 6, end of year 9. So, 4 times, whereas this 12,500 is continuing throughout the 12-year period every year. Now, one thing you must understand, the assumption that we are making while utilizing this particular method. The assumption inherent here is that we will continue to get the asset A1, we will continue to get asset A1 at the same price even at the end of year 3, even at the end of year 6, even at the end of year 9. What is my assumption? Assumption is I will continue to get the same kind of equipment at the same price. In real life situation, it may not happen that way. Sometimes the prices might have gone up, sometimes the prices might come down. And that is why, while telling you about this method, I insisted on using this method only for shorter duration problems. When the duration specified is less, then only we should go in for such methodology. Otherwise, if you find otherwise you will find that if the duration is more, there could be changes in technology and thereby the changes in the investment level. So, 115,000 may become, let us say 150,000, or it may even come down to let us say 100,000. So, both possibilities may exist, and that is why I insisted on going in for smaller duration projects or a smaller duration situation, a smaller service lives. Now, the same thing I have drawn it on the screen, you can see it will be something like this. If you see, look at this screen, it is like this. The values what you see at the end of year 0 is 115,000, this is 115, 115, 115,000, and operation and maintenance cost would be 12,500 a year right from year 1 onwards to year 12. Now, the problem has become very simple. In both the cases, now I have got same life 12 years. Now, based on the concept of previous classes, you can calculate the present worth associated with both these options, right? Because we have already covered this, how to deal with a situation which involves similar life or same life period. So, now for asset 1 also we have reduced it to 12 years, for asset 2 also we have reduced it to 12 years. So, here again you can solve or you can find the value of net present worth either by using the formulas or by using interest factor tables. Technology class, have you got the interest factor tables with you? Technology class, please. Did you get some textbook through which you can Xerox the interest factor tables? Do you have a textbook there? Okay, then what I will do is I will send you the interest factor tables also. It is not a difficult thing to make, you can do it in Excel also. You have got all the formulas with you, you can put it in Microsoft Excel and you can generate those interest factor on your own. What I will do, I will send you tomorrow different factors corresponding to different interest rates, because I want you to bring those interest factor tables in class, so that it becomes easier for you to solve the problems, right. So, from next class onwards please bring calculator as well as interest factor tables. So, for finding the net present worth for asset 2, first we will see for asset 2 part. You can find that, let us bring the asset 2 part here, asset 2 part here. How to calculate net present worth, that is the problem. So, net present worth can be found out very easily for this case. See, this is at time t is equal to 0 itself. So, there is no problem. This 160,000 is equivalent to 160,000 only at time t is equal to 0. So, its present worth is same. Now, I will try to convert this amount and try to bring it here. How do I do this? This becomes my future value. I am interested in finding P. I am interested in finding present value. I know my future value which I have to incur, which is equivalent to 160,000. So, which formula I will use? I will use P given F. For an interest rate, let us say it is 15%. P given F 15% for how many years? 4. So, this would be 4. So, this factor I will see from the table and multiply it with this 160,000. All these things are in negative side. When it comes to this 20,000, I will calculate the same factor P given F 15% for a time period n is equal to 4 and multiply it with plus 20,000. Why? Because it is in plus side. This is one way. Other way could have been, I take the algebraic difference between this and this. Why I am taking algebraic difference? Because they are at the same point of time. At the end of year 4 itself, I am paying 160,000 and at the end of year 4 itself, I am receiving 20,000. So, how much is my net outgoing? 140,000. So, I can very well change this cash flow diagram in something like this. Here I have 160,000. This becomes 140,000. Again this becomes 140,000. And finally, I have 20,000 here. This is 0, 4, 8 and finally 12. So, this way also I can try to solve the problem. I am able to do this because it so happened that receipts and outgoing, receipts and expenditures were at the same point of time. That is why I could do algebraic difference. So, now this becomes very simple. The net present worth NPW would be 160,000, of course, in negative, minus 140,000. This becomes F for me. I am interested in finding P. So, I will write the factor P given F for an interest of 15% for a period 4 minus again 140,000 multiplied by P given F 15%. Now, the period is 8 and finally, a plus sign would appear because I am dealing with this. So, this is in plus side. So, which would be plus 20,000 P given F 15%. How much would be the value of N? It would be 12. So, this is very simple. Once you have equal lives for both of your alternatives. Now, in the same way, can you try the net present worth for asset 1? Remember, this calculation is for asset 2. This calculation is for asset 2. Now, we will repeat the similar methodology for asset 1. Now, let us move to asset 1. So, for asset 1 it is like this. I already have this made. It would be like this, 115,000 at 0, then 3, 6, 9. So, this is repeated 4 times. Here you have 3, 6, 9, 12. Now, for each of these, we have additional expenditure amounting to 12,500 per year. Now, this must be very clear to you. 115,000 initial investment, I am repeating it 4 times at the end of year 0, at the end of year 3, at the end of year 6, at the end of year 9 and at the end of year 12. So, the net present worth I will compute like this. All the terms are in negative here because they are all representing cost. So, cost I am taking as negative, it is going out of my pocket. So, it would be minus 115,000 as it is. Why? This value is at time t is equal to 0 itself. Time t is equal to 0 itself, so no change. Whatever amount is given, that itself is its present worth. Now come to this, it would be minus 115,000 P given F 15% for a period 3. So, this is also taken. Now, come to this, this would be minus 115,000 P given F 15% for a period 6. And finally, 115,000 P given F 15% 9. So, we have taken care of this also. Now, we have to take care of operating expenses, which is 12,500 every year for next 12 years. So, how do I take present worth for this situation? I am given annuity A. If you see, amounts are all same. So, annuity value is known to me. What I am interested? I am interested in finding P. So, I will simply be using P given A for 15% interest rate for 12 years. So, finally, the last term would be, it would again be in negative side, minus 12,500 P given A 15% and this would be 12. I will repeat, this would be minus 12,500 multiplied by P given A for 15% interest rate and for 12 years, n is 12 here. So, whatever is the value that you are getting, you can find it out and then you can compare the two net present worth, one corresponding to asset 2 and other corresponding to asset 1. And now, you can tell me which asset you are going to select. So, this is as far as common multiple method or repeated project method is concerned. Clear? So, we have covered common multiple method or repeated project method, and this method we will be using when we have unequal lives of different alternatives. The second method is called study period method. Study period method is the second component. Study period method is the second way of solving problems involving different lives or unequal lives. Now, I will introduce you to this method, but the example related to study period method I will cover up in some other lectures when we take up annual cost and annual worth method, because at that point of time it will be easy for you to understand. So, for the time being I will just tell you what study period method means, but illustration I would give you in next lecture. Basically, in this method a study period is chosen. The study period is decided based on the length of the project or the service lives of the alternative. So, when you talk of two assets, one with a life of 3 years and another with a life of 4 years, the study period normally is taken as the smaller of the two alternatives. So, in this particular example, if for asset 2 life is 4 years and for asset 1 life is 3 years, then a study period in most of the cases would be taken as the life of the shorter life, So, out of 3 and 4 the study period normally would be taken as 3 years. If you take another example in which an equipment has got a life of 5 years, another equipment has got a life of 10 years. So, a study period would normally be taken as about 5 years, but in some situation the study period could be even lower than the life of the shorter alternative. So, for first example wherein we have taken two assets, one with 3 years and another with 4 years, a study period could be taken as 2 years also. Now, this 2 is lesser than 3. So, that kind of study period can also be taken, but in most of the cases the study period is taken as the shorter of the two or the smaller of the two lives. Now, the basic assumption in this particular method is that all the assets will be disposed of at the end of study period, even though they are capable to serve you for higher periods, for longer periods, but we will restrict our study only for the study period which we have assumed. We are not concerned what happens beyond our study period. So, that is what you have to understand very clearly. First thing, study period is normally taken as the lower of the two values. That is point number 1. Point number 2, in some cases study period could be taken as the lower of the lowest also. So, if I take the example of 3 years and 4 years, in most of the cases the study period would be taken as 3 years. However, in some cases it could also be 2 years, just to summarize that. Now, for this particular illustration of this particular method will be covered in next lecture when we see annual cost and worth method. And then what we do here right now is to move to the situation in which different alternatives have infinite lives. That is the last case as far as present worth analysis is concerned. So, we have already covered two situations, one in which equal lives were applicable, second unequal lives, and third one we will move to, as you can see in this particular slide, alternatives with infinite lives. Alternatives with infinite lives. Now, why we are calling this infinite lives? In yesterday's lecture I had mentioned, I had requested you to go through the interest factor table and observe the values corresponding to higher values of n. I had requested you to go through the interest factor table corresponding to higher values of n. You will notice that as you increase the values of n, the gap would be reducing. Either it would be increasing at a very slow rate or it would be decreasing at a very slow rate. So, that increase and decrease at higher values of n gets more or less stabilized. So, if you see n beyond let us say 50 or beyond 60, the factor values will not differ by much. Now, this is what is used as far as civil engineering structures are concerned. You will find that for all practical purposes, civil engineering structures such as dams, power projects, tunnel projects, they have got a very long life, 100 years, 150 years, even 200 years. So, for all practical purposes, we assume that they have got infinite lives. Now, when we are bringing this infinity into picture, you will find that all our formulas which we had derived for discrete values of n and finite values of n will become very simplified. We will see this. Now, one approach which is very popular for solving such type of problems is called capitalized equivalent method or CE method, capitalized equivalent method or CE method. Now, I will tell you what this capitalized equivalent means. Basically, capitalized equivalent is the difference of basically the present worth of cash inflows and outflows. Now, all this capitalized equivalent is calculated at time t is equal to 0, that means now, at present. And here we assume that whatever cash inflows and outflows are occurring, they are occurring throughout the life, and that particular term is known as perpetuity. That particular term is known as perpetuity. So, if you see, I will write it here, it is known as perpetuity. What is the difference? Annuity is for a finite period. If you remember, in previous classes we have discussed about annuity. This term annuity is for a finite period. Same amount either you are receiving or you are paying someone for a finite period. So, if you have let us say 1000 rupees let us say for 5 years, year 1, 2, 3, 4, 5, this 1000 becomes annuity. So, same amount either paid or received for a finite period is annuity. Now, the difference between annuity and perpetuity is this. Assume that this 1000 you are going on receiving throughout your life. Let us say 100 years or let us say 150 years or maybe 75 years, it is as good as infinity. So, then this 1000 becomes perpetuity. Equal amount of money paid or received throughout the life is known as perpetuity, whereas if it is for a limited amount for a limited time period, we call them as annuity. This is just a simple definition which you can understand. Now, it is very easy to calculate formulas for such cases. I have a cash flow in perpetuity. I will find its present worth at time t is equal to 0. So, I want to develop a formula that you can see it how to derive that formula by looking at this particular slide. Mathematically, if you see, capitalized equivalent is equal to A multiplied by P given A. Remember, we are interested in finding P, present worth. I know A. Now, A here is for infinite period at an interest rate of I, and you notice this n is equal to infinity here. So, this is what you have to understand very clearly. All these computations we are doing it assuming that n is infinity. So, in your formula for P given A I n, you put the value of n is equal to infinity or n tending to infinity. You can solve that as a limit problem, and you will find that you are getting a very simple outcome, that is, it is nothing but A divided by I. So, the formula becomes very simple for capitalized equivalent, and this has been possible by assuming that n is tending to be infinity. N is tending to be infinity. This you can cross check based on your knowledge of limit, you can, and calculus obviously you can find out this derivation. For the time being, just understand that capitalized equivalent is A divided by I. A is your annuity, that means equal sum of money divided by rate of interest. Now, normally for such long duration project, you will find that interest rates are small. Now, this kind of analysis you will find them to be very, very useful, especially to compare long term projects. It could be a long road works, highway, expressways, and you may want to come out with the maintenance corpus. So, for such kind of scenarios, you can employ this capitalized equivalent method and evaluate your alternatives. Now, this aspect also will be more clear if we take up a very simple example. So, if you have noted down the formulas, I will take you to a small simple example, and you will find then the concept should be more clear. Now, note down this example. A small check dam. Check dam is basically to stop passage of, just to stop the flow of water, right. It is a small dam, not in it's not in very high magnitude, it is a small dam basically, just to prevent flow of water from one side to other side. You want to store them, so you construct check dam. So, small check dam A, it is costing rupees 50 lakhs. Now, 1 lakh is 100,000. Just to remind you, it is costing rupees 50 lakhs to construct, and it will cost rupees 7.5 lakhs a year to operate and maintain. Now, there is another design for the same dam, and if you construct according to that plan, it is costing you 75 lakhs initially to build, and it will cost rupees 5 lakhs a year to operate and maintain. Clear? First design is costing you 50 lakhs and operation and maintenance cost of 7.5 lakhs. Second one is costing 75 lakhs and an operation and maintenance cost of 5 lakhs every year. Now, read the next line. Both installations are felt to be permanent. This is the key thing that you have to understand. It is nothing but a hint to you that this is a problem with infinite lives. Permanent means it is going to stay there for, throughout the life. So, this point you have to understand, both installations are felt to be permanent. Now, the minimum required rate of return, which is nothing but the interest rate, for the time being you understand, interest rate is 5%. Your question is, which alternative should be preferred? So, now you must be understanding why this problem is little different than the earlier two cases. In first case, the lives were equal. In second case, lives were unequal, and this is the third case in which you are told that both the dams are going to stay there forever. So, the first step remains same. You have to draw the cash flow diagram for both the option. If you are able to draw the cash flow diagram, more than 50% of your problem is solved, because cash flow diagram gives you the clarity. I will just try to help you in making the cash flow diagram. Let us say first I will draw for check dam A. Check dam A, I need to invest rupees 50 lakhs now. I will write lakhs as L. So, rupees 50 lakhs I am investing now. In addition to this, how much more I have to invest towards operation and maintenance? 7.5 lakhs every year. So, this is 7.5, 7.5, 7.5. Now, since dam A is permanent as well as dam B, so this is going on till infinity, right. So, I can say that n is tending to infinity or n is infinity. So, this is as far as dam A is concerned, cash flow of dam A is concerned. Now, on the same manner we can compute the cash flow diagram for dam B. How the dam B's cash flow would look like? In the beginning, I have to spend more money. How much? I have to invest 75 lakhs. So, I am writing 75 L. This is at time t is equal to 0. Now, every year, year 1, year 2, year 3, this continues forever, n is equal to infinity. How much is the amount? Now, I have a reduced maintenance cost 5L, 5L, 5L and so on. Now, what I have to do? I have to find the capitalized equivalent for both these dams, for both these cash flow diagram. This is for dam B. Now, your formula is very simple. I am interested in bringing all the sum at time t is equal to 0. So, what happens? 75 lakhs is here itself at t is equal to 0 itself, right. So, the net present worth or net present value, in this case you can also write them as capitalized equivalent CE, is, if you want to write negative, it is minus 75 lakhs minus how much? A divided by I. A is 5 lakhs divided by I is how much? 5%. So, it is 0.05, as simple as this. So, you will find that this becomes minus 175 lakhs. Forget about the negative sign, it means that you have a liability of 175 lakhs if you go for dam B, or rather if you follow the design B. In the same manner, you can calculate the capitalized equivalent for dam A. It would be equal to capitalized equivalent CE for this would be minus 50 lakhs minus 7.5 lakhs divided by 5%, which is 0.05. And you will find that this is coming equal to minus 200 lakhs. Forget about the negative sign only indicates that it is going out of your pocket. So, your total cost liability, if you go for this design, would be 200 lakhs. Whereas, if you would have gone in for the first design, I mean design B, it would have resulted in 175 lakhs only. So, now it should not be difficult for you to decide which design options to proceed. One which has got a lowest cost liability, that would be the right option for you, right. So, in this particular lecture what we have covered is, I had given you the review of situation involving equal lives, and then in this particular lecture we mainly focused on situations involving unequal lives, and there I showed you two methods. One was common multiple method, which is also known as repeated project methods. I also illustrated you this methodology using one example, and then I briefly described what is the process involved in study period method. Although I did not give you example for that, this example I will take up in next lecture, and then finally towards the end of this lecture we covered the situation involving infinite lives. I showed you how to calculate the capitalized equivalent and then how to draw the decision as far as the situations involving infinite lives are concerned. If with this I close this lecture, and I invite, if you have got any doubt, you may please ask so. Already these emails, I mean already these handouts have been sent to your class representative as well as to your course instructor. Thank you.
Hello.
Yes.
Hello, doctor.
Yeah.
During the common multiple method,
Yes.
where we assume the cost of that equipment that used in different years on the trade analysis,
Yes.
we assume the same. We assume the same cost.
Yes. That is why I told you
How can we assume?
this is our assumption, and that is why I told you that this analysis method you should use only when the time involved is very small. There should not be any possibility of technological changes, because if there is a change in technology during that period, the cost may either go up or it may come down. That is why I told you to restrict this particular method for small periods only, because otherwise the cost would vary. The equipment which I purchased at 160,000 today, I may not be able to get the same equipment at 160,000 alone at the end of 3 years. It is not possible, because 3 years is a long period. So, these are some of the limitations of this particular method.
Okay, the second question,
Yes, please.
in the study period,
Yeah.
where we take the lower of the list,
It will be specified. Yes. It will be specified in the problem that you consider only 2 years. If nothing is specified, you take the lower of the two. Suppose one alternative has 3 years, another alternative has got 4 years life. If nothing is mentioned, take 3 years as the study period. However, if problem mentions that you take 2 years only as a study period, then you forget whatever is happening beyond 2 years. You forget that. You concentrate only on first 2 years.
please can you tell me the cases, in what type of cases
Pardon me?
can we take the lower of the list?
Lower of the list. Can you hear me? चलिए, हमारा तो खत्म हो गया ना, या रिकॉर्डिंग चल ही रहा है? ये तो रिकॉर्डिंग में नहीं आएगा ना? अच्छा.